battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office for the past 45 years, if you can believe it. It's been our family's mission to deliver clarity and confidence to help secure your financial future. You were thinking, Nick, where were you? Where was the show for the past 3 weeks? And we were on the road visiting clients. We were getting lots of meetings in, but let not your heart be troubled. We are back at it. We are back in the studio here. We got Katie the Greek producing the show today, episode 221, if you can believe it, Investing Dumpster Fire. We're going to get into that title in just 1 second in the content of the show today. But before we do, I just want to remind you, Investor Day is right around the corner. Don't forget to sign up for this thing. Katie is going to put a link in the description on YouTube so you can register directly and also put it up on the screen for you to scan the QR code. But don't forget to register for this thing. We are almost full. We got a ton of signups in May already, and I believe there's about 28 seats left, 28 to 30 seats left, and then it's completely full. It's only May, but the conference is coming up in October 8th and 9th in Oak Brook. Don't miss this thing. The legendary Tom Lee, who has been spot on, who has nailed the call for years now and has been right on the money. When everybody wanted to go bearish, he kept everybody bullish and on their plans, just like we have told you to stay on your plan. And so you have to come see Tom Lee Investor Day right around the corner. Don't miss this thing. I've had so many people on the phone tell me, Nick, I have been meaning to sign up and just forgot to do it. Well, this is one of the last times you'll have. We'll maybe send out one more email reminder, and that'll be it. So don't forget to do it. That's why you have to come back to the show every week. Why? To also get the clarity and confidence, the good news, reasons why you have to stay on your plan. And every single year we have a doom and gloom event that happens, that occurs, and you just have to remember the data, mass statistics, the reasons why the market is going to go up over time. It's not to say that we're perma-bullish. It's not to say that we would never turn bearish. If the data suggests we should turn bearish, we might. We might tell you, hey, stocks are a little pricey. But that's just not been the case. It's not been the case for the past couple years. Certainly not since the financial crisis and coming out of the GFC in 08 and 09. The stock market's basically been on sale for years and years and years. It's not the cheapest it's ever been today, of course. It's not the cheapest it ever was since 08 and 09. There's been times where you could have bought the S&P at 12 times earnings, and that's certainly not the case today. But it is not the case that it is radically overvalued. It is not the case that the S&P is at the level it was from a valuation standpoint in the late 90s. And so every time we hit one of these all-time highs in the stock market, which I just want to show you our call that we made for the S&P. This is December 22nd, 2025. Katie, if you could throw that up on the screen there. This is our price target for the S&P that we put out at the end of every year leading into the new year. And we told you, based on math, based on the data, we thought the S&P would reach about 7,700 points by the end of 2026. Well, we were directionally right. It's already May, and the S&P is almost 7,500 again. It hit 7,500, was the all-time high, and it's about 7,450 today. And so how did we get this call right? Well, it's just a basic equation. It's just math. It's earnings times price. It's what do we think future earnings are going to look like, forward earnings, and multiply that by what do you think those profits are worth. And so why is it that the S&P's PE ratio has gone up slightly? It's not up significantly. It's hovered around about 18 to 20 times earnings for a very long time. Why is it that valuations are up just slightly? Why is it that earnings are up so much? Well, there's really a couple things going on, but companies today are more profitable than ever before. And we talked about this last episode, rather, that the S&P's profit margin about 10 years ago, which is really not all that long ago, the S&P's profit margin in 2016 was sub 10%. It was about 9%, 9.25%, 9.5% for some industries. And today it's over 15% for net margins. That's a substantial increase. It doesn't sound like it in a vacuum. It doesn't sound like it over a 1 or 2 year time frame. But when you do that kind of growth in earnings over a 10-year time frame, it's about a 3 to 5% annualized technology premium is what we call it. It's companies leveraging technology to increase profits and make things better for their customers and everybody else. When you do that consistently over time, you end up with the S&P sustainably over 7,000 points. And so remember, pre-COVID, we were sub 3,000 points. We were about 3,000, just got over 3,000, then COVID hit, and today we're over 7,000. And so every single time we go through one of these big runs in the S&P, which has not been without a bunch of corrections, a bunch of pullbacks, people have forgotten this. People have amnesia in the stock market, and they forget all these pullbacks. We had 2020 with COVID. We had 22 with the Fed rate hikes. Don't forget this data point that we were down 25% in 2022 at the worst point. So we're going to have corrections like that. And I think we're due for another one probably next year sometime, not out of the ordinary. We had Liberation Day last year. We were down 21% or so. Then we had Iran this year. We were down significantly, down to 63.50 on the S&P. So given all these pullbacks, all these corrections, we still continue to hit new highs. And every time we do, there are bearish people, there are pundits who come out of the woodwork and tell you why the sky is falling and why this is a bubble. That's the favorite term of the media is bubble. And so people see bubble and they get a little bit worried because it makes them remember of 08 and 09. It makes them remember 1999. That was the most famous bubble in recent history, and there's been other bubbles since, but those are the big ones that stick out. And they say this time is the same thing. We're going to have a bubble. We're going to have a massive crash in the stock market. And really what it is it's not based in reality. It's not based in data. It's not based on that formula, earnings times price. And when you start to believe that, because you aren't looking at the data, you can get really nervous. You can start to do some really bad things like selling your equities. You can go into gold bars and cash and canned food and build a bunker in your backyard thinking that the sky is falling. But like I've told you before, there's really no sense in betting against the end of the world. If you bet against the end of the world, maybe you're right, but it really won't matter at the end of it. There won't be a Costco to take your gold bars to and turn into food anyways. So who cares? You might as well be bullish, and that's really been our advice. And so, again, not perma-bullish, bullish in the sense that when you look at valuations today and you look at forward profits, as long as forward profits support the valuations, the price we're paying for equities, you can buy stocks expecting good returns over time. You may not get 20% returns like we have for the past 3 years. That's the annualized return on the S&P now, a little bit north of 20%. You may not get 20% going forward, but it would be very typical that you'd see double-digit returns. I've shown you that math before. It's not that hard to get to a double-digit return on U.S. equities when you take into account dividends and buybacks, technology premium, just basic inflation-beating power of equities. And when you add all that up, I think that's long run still where the S&P is going to be. I do not think, just very definitively want to say this again today, I do not think we are in a bubble. I don't think we're anywhere close to a massive bubble. Maybe in some stocks, maybe in some pockets of AI, no question, some pieces of technology are overvalued. But when you look at J.P. Morgan and Procter & Gamble and McDonald's and Morgan Stanley and even Apple and Microsoft and Facebook and all these great companies, not telling you to go buy any of these, but when you look at these pipes and wires companies of the stock market, you just don't see 30, 40, 50, 60 times earnings multiples. You just don't see them. And that's what happened in the late 90s. You had companies like Cisco trading 300-400 times earnings, 300-400 PE ratios, and that was unsustainable. And even with Cisco in the late 90s trading at 300 or 400 times forward profits, which was ridiculous, we wouldn't want to buy a company like that long run. even paying that 26 years later, now finally you're starting to get a return. And even if you bought the NASDAQ at the peak in the late 1990s and you held on 26 years, you got 8.5% annualized returns now. So that's the doom and gloom scenario, is you just have to wait. But in the meantime, for our clients who are getting close to retirement, in retirement, who are certainly well into retirement, we just pay attention to valuations. And so what tends to be a really good investment strategy over time is doing exactly what I said before, which is buying the pipes and wires. It's the companies that are not necessarily making the technology. They're not manufacturing tech, but they're using tech. And it's why you could drive down a road in Naperville here, like Ogden Avenue or Roosevelt Road and Wheaton there, and you could go past 6 or 8 empty bank branches. And why is it that banks don't have to have the same amount of bank branches anymore? Because most of us do everything on apps, and apps cost pennies versus bank branches that cost millions. And what has that done all across the various industries that you invest in your portfolio? Well, it's done wonders for earnings. And so what's really important to understand, this is an accounting concept, but what's really important to understand is earnings are not linear. They're not a direct correlation to dollar for dollar to revenue growth. You can get 10% revenue growth, for example, that ultimately translates into 20, 30, 40% sometimes earnings growth. Why? Because we start to look in accounting at what's called operating leverage. And what we want to find out is how much revenue growth do you need to translate into 20, 30% earnings growth? And by the way, you don't really need 20 or 30% earnings growth long run to get a great return. You can build a great return in a portfolio off of 8, 10, 12% earnings growth. And so even a 6, 7% revenue growth number doesn't seem that exciting. It doesn't sound like a big number, and it's really not. But a 6, 7% revenue growth number with a great management team can easily turn into 10, 12% earnings growth over time. And that's why we haven't gotten bearish. The only thing we've watched is valuations. We've paid very careful attention to what price are we paying for that earnings growth. And again, right now, you're not paying a whole lot, a lot more, I should say, over what we paid 10 years ago. We're not paying that much more for earnings than we paid the past 5 years. And if you get into it and you actually get into the S&P 500 and have laser-like precision over what you're buying, which is what we do at Stenger Family Office, you can actually get into valuations that are lower than the general market. If the general market's 22, 23, 24 times earnings, you may be able to find companies pretty easily that are high quality that might be trading 16, 17, 18 times forward earnings. And in my opinion, those are pretty darn good deals. So that's how we build the portfolio. And again, if you're paying attention to this, you are not going to be in a bubble scenario. So I reject this idea that just because we're at 74.50 on the S&P, that the market's overvalued. And in fact, it's going to feel even scarier as we climb to new heights. It's going to feel scarier as we hit 8,000, as we hit 9,000, as we hit 10,000. But again, mathematically, going from 3 to 6,000 on the S&P, which we've already done, is much harder mathematically than going from 6 to 10 or 7 to 10 or 7 to 9. And so because of that, you're going to see people abandon ship. They're going to jump off the ledge because they think that stocks are overvalued. And it's simply because they're not paying attention to earnings. And so if you think about where earnings estimates came in during 2026, really at the end of 2025 for 2026, we were seeing earnings projections in the 12 to 16% growth range, which we thought was incredible. We thought that was really good. And in fact, I built our model based on like 12 to 13% earnings growth, being a little bit more conservative. And we thought maybe earnings would surprise 16, 17, 18%, maybe. And that's what Wall Street thought too. Well, the real number is now for Q1, and the companies that have reported earnings so far on the S&P, that real number is not 12%, it's not 14%, it's not even 18%. The real number now for earnings growth is 26%, which is one of the highest numbers it's been for 5, 6, 7 years now. So despite all the growth, despite all the record run in the S&P's level, it's all being supported by record earnings growth, which is even higher than it's been in recent history. So again, this is not a Faguzzi-Wazzi. It's not built on a fantasy. It's built on the reality of strong earnings. And so you ask the question, why is it that companies are putting up the earnings numbers they're putting up? And one of the reasons, of course, is people are going to point to AI and layoffs. Well, there are some layoffs, but it's not enough to really explain the earnings growth, because layoffs have only really accounted for maybe across the broad economy, maybe 0.5%, 0.75% of savings on margin. It's not enough to explain 26% earnings growth. And so instead, what I look at is a company like IBM, again, not an investment recommendation, but I'm just going to use IBM as an example, where they tried years ago. They were way ahead of the AI curve. AI is not new. It's been around for a long time. And IBM was early to the game because they're a tech company, and they were early to the game using AI. Well, one of the big decisions they made years ago was to cut a lot of their entry-level positions. They said, we're not going to need entry-level college graduates anymore because we're just going to use AI. Well, it turns out that that's not possible. It turns out that AI is good, but you still need people to do jobs. And so they've had to do a massive, massive pivot, and they don't have any succession planning now. They've completely goofed up on succession planning, because as people retire, they don't have new people coming in who have had 3, 4, 5, 10 years to learn these jobs, and you can't replace experience with AI. You just can't. It will never. And I would make the bold claim today, for all the AI people who are worried about everybody losing their job, it's just never going to happen, because at some point you have to apply wisdom to situations, not just knowledge, and wisdom is in short supply. And so when you get rid of all of your legacy people, when you get rid of your 20, 30, 40-year experienced people, you've got a real problem. And I think a lot of companies are looking to IBM now saying, wait a second, we've got to be a little bit more cautious here. Now, you may say that sounds counterintuitive or ridiculous because, Nick, I'm seeing layoffs at Meta, I'm seeing layoffs at Amazon and all that, but those layoffs are not AI layoffs. And again, sounds ridiculous, but I'm going to make the point, which I made actually about 6 years ago now, during 2020, that companies were overhiring, and now they're unwinding a lot of the overhiring they were doing. They hired maybe 20, 30, 40, 50,000 people more than they really should have, and now they're laying off 10 or 20,000. So again, if you take the media for face value and you just read a headline that says there's 10,000 layoffs going on at Facebook today, well, just be careful, because they've probably, in reality, are still way over the headcount they had in 2019. And so you're going to see some back to normal reality decision-making happen where people just overhired. They overestimated some of their numbers. They realized they didn't need all the people they needed. But when you look at unfilled jobs today, which is the other side of the unemployment debate, unfilled jobs are still at basically close to record all-time highs. Unfilled jobs are close to 7 million, which is about what we went into 2019 with. And it's not like AI just came out yesterday. AI has been around for multiple years now, a lot longer than people realize. Even since 2021, plenty of people were using AI. They were using, there was a company called UiPath, still is, that was doing a lot of RPA and robotic automation and things like that. Well, if AI was going to push everybody off a cliff, it would have started in 2021. You just haven't seen that in the data. So rather, I think what you're going to see is long-term the opposite problem, where companies are going to have to hire again, and we're going to be back to a labor shortage within a period of time. Because every time there's a tech wave in the country, every time we have something like this AI wave or like the third or the second or the first industrial revolution, people end up doing different jobs, but there's more abundance created on the other side of it. So one of the best examples of this that we can all think about is the fact that 40 years ago, there was never, ever such a thing as a cybersecurity analyst. Well, today, that is one of the most highly sought-after jobs, is to be a cybersecurity analyst, and it's a very high-paying job. So there are all these new jobs and better jobs that are created, and I've given you the example of the 1800s with the blacksmith and how the blacksmith got completely displaced when the cars came out and the machines came out. But now to make a car, it requires something like 36,000 unique supply chain components that didn't exist when blacksmiths were making horseshoes. And so that's how the economy works. You've got to think about the economy in terms of abundance and what it creates rather than what it destroys. And of course, there's creative destruction. I'm not saying that every person who drives a cab today isn't going to be pushed off by Uber or by driverless cars. I'm not saying that. And we feel bad for people who get displaced. That is a real part of the economy. But that's why we've told our clients, stay ahead of things, make sure you're you're staying ahead of the curve, you're learning technology, and as long as you stay up with the times, you're going to be okay. And that's what we've seen long run with technology. That's what we've seen with the economy. There are always better outcomes on the other side of technology than we went into. And there's got to be guardrails, there's got to be risk management, there has to be rules of the road and some regulation to deal with all the unknowns out there that we're going to deal with. But human nature and the United States in particular, our entrepreneurs have proven that we figured it out over time. So that's what we've said to our clients. You don't know what technology is going to exist in 5 years. You don't know what's going to be out in 10 or 20. So buying those tech companies and putting your entire portfolio in them would be a bad idea. But buying the companies that can leverage tech and they have great teams, they can pivot quickly and be entrepreneurial within their business models, whether it's financial services or healthcare or any other industry across the S&P, will ultimately benefit from tech. So that's where we've seen the earnings growth. That's where we've seen revenue growth. And again, it doesn't take a whole lot of revenue growth to get the earnings growth that we're seeing today. So I will tell you this, I think the S&P is headed higher from here. We're not adjusting our price target quite yet. Maybe we will, maybe we won't. But for now, we keep saying 77.22 is where we think the S&P ends up. Maybe we overshoot. Maybe it's a little under. I don't know exactly. But what I would tell you is I think directionally speaking, you will see S&P 8,000, 9,000, 10,000 a lot more quickly than you realize. And to try and time this next time you see a correction, to try and get in and get out and know when to hold them and fold them and walk away and run, it's just not possible. You're not going to do it. Nobody could have predicted that the year that we went into COVID and shut down the world, for example, that the stock market would finish positive 20%. Nobody could have predicted Liberation Day, that we would finish positive like we did. Nobody could have predicted Iran, that we'd go into that thing and the stock market would be at 63.50, and now we'd be at 74.50 that quickly. Even we thought it would have taken a little bit longer. We still told you to stay on your plan, don't panic. But you just can't time it. You will not time the market successfully over the long run. Instead, you're better off staying on your plan. And I'll just leave you with the three drivers of this bull market. What is driving these companies to the highs that they're at today? Well, it's this three-pronged bull market that is almost impossible to derail. Number one, the baby boomers, 10,000 a day retiring. What do baby boomers do when they go spend money? We see it every day. They are out in the economy. They're going on trips. They're giving money to their kids and grandkids. They're doing the things that they've been waiting 30, 40 years to do. So that is the number one driver of the bull market. Baby boomers, and if the baby boomers don't spend all their assets, where are they going to leave it to? They're going to leave it to the millennials and Gen Z. That's the second driver. And millennials are going to inherit trillions of dollars over the next 20 years. But more importantly, millennials have their own money to spend. And I just heard this salary the other day, which you wouldn't believe. Starting salary for a CPA at the Big Four, this is Deloitte, PwC, Ernst & Young, KPMG, now in the $85,000 range for a starting salary CPA. And so if you have a skill set that's in demand and you can go to school and come out with the CPA license and everything else, you can make good money. And so the idea that millennials are doomed and they can't afford anything and will never be able to buy houses, I just don't see that. Largely speaking, millennial net worth, this is the most recent stat now, is up 4x over what it was in 2019. And so that's the number two driver now of this bull market. And then the third thing is emerging markets. We're seeing explosion in Latin America. I have a friend who does a lot of investing in Latin America, and it's been the stories that we'll hear are just incredible of the growth. And all across the world in these places where they're leaving $2, $3, $4 a day in living standards and they're going to $8. Well, that's a double. That's literally 100% growth. And so those are that's the third driver of the bull market. And when you take these three factors together and you add them up and you look long term, it's almost impossible to derail these structural pieces long run. And that's what's going to drive the stock market forward. It's not going to be without corrections. It's not going to be without pullbacks. We love it to be in a straight line to the upper right. Never happens, never will happen, never happened in U.S. history. We're going to have bumps and bruises. And that's the price you pay to own equities, the inflation-beating asset class over time, the best inflation-beating asset class over time, is you just have to deal with some volatility. You have to deal with some ups and downs. So, again, I'm going to urge you stay in your plan. Don't panic. You're going to see a pullback at some point here later this summer. Not going to be a surprise. And I do think we're going to head to new all-time highs by year end. So thank you for being with us here on this week's show. We'll see you next time for 222.